Minneapolis Fed President Neil Kashkari saying he wants to see many more months of positive inflation data before the central bank cuts rates. For more on that, I want to bring in Dan Tarullo, a former Fed governor, led the central bank's financial regulatory reforms in the wake of the financial crisis. He's now a Harvard Law School professor. Good morning to you. He's got a new piece out for Brookings Hutchins Center saying reconsidering the regulatory uses of stress testing should be something to be considered. Dan, it's nice to see you. What do you think the chances for a rate hike now that that seems to be on at least Mr. Kashkari's table?
Well, Andrew, I actually looked a little bit more closely at Governor Chris Waller's speech last week. And I thought what he did in that speech, a very good speech, was two things. One, I think he pushed back some on the idea that there's a significant chance of a rate increase. And the second thing he did was to, I think, reflect the sort of the broad view within the Fed that they are going to need to see some more progress on inflation absent something pretty bad happening in the labor market. And I would draw your attention to that second part of it. In his summation, Governor Waller said, yes, I want to see several months more of good inflation data. But he said in the absence of negative developments in the labor market. So he's still keeping both sides of the dual mandate in mind. I do think, though, that he was pretty forthright in pushing back at the idea that a rate increase might be looming there.
So when you think, though, about as we get into the fall, and we keep saying the election's coming and everything else, even if you think that, for example, Jay Powell may be predisposed to wanting to lower rates, what do you think the chances he even wants to touch rates before the election?
Yeah, I mean, I think to a considerable extent, Andrew, I think there's more sensitivity to this issue outside the FOMC than there is within the FOMC. I mean, I think from the FOMC's point of view, they've been talking for some time now about the conditions under which they may lower rates. And if those conditions are met, if, for example, Governor Waller's preconditions of several more months of good inflation data, showing that inflation is moving back to target on a sustainable basis. If those are met, then I think the FOMC would be inclined to go ahead with what it otherwise normally would do. Secondly, if there were to be some sort of, at this point, unanticipated shock to the economy or unanticipated significant negative developments in the labor market, I don't think the FOMC would hesitate to lower rates.
Do you think, we had a debate about this the other day, do you think that the transparency that the Fed has now created its own problem? I mean, do you think that this is a good strategy, a bad strategy to sort of tell us what they're about to do?
Well, there's no question that transparency can be an important tool of monetary policy. And I don't think anybody wants to go back to the days where people had to sort of look at tea leaves to even figure out what the Fed had done, much less why it had done it. But I do join others in wondering whether there's kind of an overload of information right now, number one. And number two, and I think you're referring to sort of the forward guidance in non-crisis periods. And as retiring Cleveland Fed President Mester said, during crisis periods, forward guidance can actually be quite useful when rates are towards the zero lower bound. But I wonder whether in normal times, the inclination to say, here's when we're going to change, here's when we're going to move, at the same time that you're saying you're data dependent, isn't a little bit at odds with it. Those two tendencies are a little bit at odds with each other. And so it might be that the Fed would be better advised to talk about its general expectations, talk about the conditions under which it would be comfortable lowering or feel the need to raise rates, and then let the market draw some more inferences. Because I do think at this point, the markets are kind of overreacting every time some member of the FOMC gives a calendar period during which he or she expects that there could be a rate change.